Gentlemen, let me welcome each one of you to this press conference. With me on the dais are Mr. Atanu Chakrabarti, who is the chairman of HDFC Bank, Mr. Shashi Jagdishan, the CEO of HDFC Bank, and my colleague Keki Mistry, vice chairman and CEO of HDFC Limited. I was a little disappointed at the press intelligence that no members of the press decipher this, because it's always you are one day ahead. Tomorrow's news you are supposed to give today. And I was disappointed that you failed this time. But we tried our best. The work was going on for the last 3 weeks, and we tried our best to keep the number of people involved limited and strict no talking. Anyway, the board of directors of HDFC Limited and the board of directors of HDFC Bank, at their respective meetings held today, have approved an all-stock amalgamation of HDFC with HDFC Bank. The amalgamation is subject to the approval of shareholders of HDFC and HDFC Bank respectively. RBI, stock exchanges, SEBI, and such other regulatory approvals as may be required for approving this merger. Only upon obtaining all approvals when the merger will become effective. HDFC will merge with HDFC Bank. Shareholders of HDFC will receive shares of HDFC Bank in exchange of the share in HDFC at the approved share exchange ratio. Bansi Mehta and Company and Deloitte Touche, appointed by HDFC and Bank respectively, have recommended a share exchange ratio which has been accepted by the respective boards. Bank of America, Merrill Lynch Securities and Morgan Stanley provided the fairness opinion on the share exchange ratio both to HDFC and HDFC Bank respectively. Accordingly, shareholders of HDFC Limited will receive 42 shares of the bank for 25 shares held in HDFC Limited. The shares held by HDFC Limited in the bank will be cancelled. Post-closing, HDFC Bank will be 100% owned by public shareholders, and existing shareholders of HDFC Limited will own about 40% of the bank. So there won't be any promoter left in the HDFC Bank. It will be all in the market. As today, HDFC has no promoters and the entire shareholding is listed in the market and can be traded. Similarly, HDFC Bank now, earlier we had 21% of the shares, now it will all be in the market. Both of us have been evaluating the pros and cons of a possible merger for mutual benefit of both institutions. The merger is coming together of equals. Customers of both HDFC and the bank will be the biggest beneficiaries. However, over the last few years, there have been certain regulatory changes for banks and NBFCs, which have considerably reduced the barriers for a potential merger. The last 3 years has seen a host of guidelines issued by RBI on harmonizing the regulation between banks and NBFCs. These have included guidelines such as large NBFCs should be converted into commercial banks, particularly those over 50,000 crore asset base. NPA classification, which was different before, Reserve Bank has now made the same NPA classification for NBFCs, housing finance and banks. The Reserve Bank has now we are required under the Reserve Bank regulation to provide liquidity coverage ratio. That means NBFCs need to maintain liquidity against the next 30 days outflow on a rolling basis. Scale-based regulation for NBFCs have been introduced by RBI, where we would be recognized as a large organization in the upper layer of NBFCs. And the upper layer of NBFCs will have a much closer and stricter regulatory requirement. Another factor is core financial solution system. RBI has asked the NBFCs to follow a core financial solutions like the bank, which is following core banking system, and risk-based internal audit. These measures have considerably reduced the regulatory arbitrage which was there between a bank and an NBFC. The strategic rationale for the proposed merger is as follows. The reduced gap in liquidity requirements between a bank and an NBFC. The SLR and CRR for banks was 27%, which has now been reduced to 22%, 18% for SLR and 4% for CRR. Interest rates are more favorable today as compared to earlier years. Banks have an option to invest in priority sector lending certificates to meet the PSL requirements as against direct lending to agriculture and MSME as in the past. With RERA and IBC, real estate is seeing an increased level of transparency, and mortgage customers can have access to a range of financial products under one roof now. Change is inevitable, but change is beneficial. Change is welcome when it is beneficial to all the stakeholders. So the merger makes the combined entity strong enough not only to counter competition, but make the mortgage offering even more competitive. We will be able to offer all the variations in the mortgage product, which currently as HDFC standalone we are unable to offer, such as an overdraft product. The funding challenges both in quantum and cost will be minimized by the combined entity. The merger will therefore capitalize on our domain knowledge in real estate and mortgages, as well as our operational efficiencies in processing mortgages, whilst leveraging the cost of funds efficiency and the wide distribution network of the bank. So the transaction involves the amalgamation of HDFC and two of its wholly owned subsidiaries, HDFC Holdings and HDFC Investments, with HDFC Bank. HDFC Limited is the promoter of HDFC Bank, and together with its two subsidiaries currently holds 21% of the share capital of the bank. Post completion of the merger, all the subsidiaries and associate companies of HDFC Limited will be owned by HDFC Bank, subject to regulatory approvals. As on April 1, 2022, the market capitalization of the bank was 8.36 lakh crores, which is 110 billion, and HDFC was 4.46 lakh crores, which is 59 billion. Asset size of the bank today is 18.4 lakh crores, and on a consolidated basis, HDFC is 8.8 lakh crores. Bank has 6,300 banking outlets and 17,000 ATMs. HDFC has 651 offices, inclusive of 206 outlets of HDFC sales. The bank has requested Reserve Bank for phased-in approach in respect of SLR and CRR, priority sector lending, as well as grandfathering of certain assets and liabilities, and in respect of some of its subsidiaries. These requests are under consideration by RBI in terms of their letter to the bank dated 1st April 2022. In the past, the merger would not have been as value accretive as present. The merger will lead to significant synergies of combined entity and a better return to shareholders. The combined strength of the balance sheet of the combined entity will be the ability to compete on not only on the funding side and the ability to offer the entire range of mortgage products, which is a win-win situation for both institutions. As the bank does not do loan origination, they originate and we appraise, and so this will be a new product. It's an addition of a bank activity. So the benefits are lower cost of funds will be made available for mortgage business. The bank will have access to time-tested mortgage origination servicing processes. Mortgage business has immense potential. Hence, the merger will help the group enhance its market share, consequent to further leveraging on the distribution. Excuse me. The merger will mitigate the single product risk, while at the same time enhance the diversity of assets of the combined entity. Under the bank structure, the features of the mortgage product can be enhanced in terms of product design. I don't know what's happened. The combined entity will be in a position to offer the mortgage product seamlessly as under the current arrangement between HDFC and HDFC Bank, where the bank sources mortgages and acquires a predetermined percentage of the loans sourced through the assignment route. Infusion of capital in the bank will no longer be a drag on ROE of the mortgage business. Subject to RBI and other regulatory approvals, material subsidiaries and associate companies of HDFC Limited will continue to be owned by HDFC Bank. This will facilitate more efficient cross-selling of banking and financial service products, including insurance and mutual funds. Value of HDFC will not be depressed by the holding company discount insofar as it relates to the shares of the bank. So the holding company discount, which is huge today, will disappear because 60-70% of the unrealized gain of HDFC were due to our holding in the bank of 21%. So the proposed merger will benefit the economy in more ways than one. A larger balance sheet and a larger capital base will allow greater flow of credit into the economy. It will enable underwriting of larger ticket loans, including infrastructure loans, which are an urgent need of the country. It will enable the delivery of the home loan offering to a large base of over 68 million customers of a bank in a seamless manner and improve the pace of credit growth of the economy. HDFC is a significant provider of home loans to low-income group and middle-income group segment under the affordable housing initiatives of the Government of India under the Pradhan Mantri Awas Yojana. Access to housing finance for this category would improve further on account of the low-cost funds available with HDFC Bank. And a larger balance sheet will also facilitate flow of a larger quantum of credit into the priority sector, which includes agriculture. I must say that HDFC will continue to operate as an independent entity on as-is, where-is basis until the effective date. Until all the approvals are received, we will continue as two separate entities with no overlap and no cross-holdings, continue as it is. So this is a requirement of one of the regulatory concerns that we have. Post the effective date, all HDFC branches, all HDFC offices in India will be retained and mortgages will continue to be offered from these outlets. Over a period of time, these branches will be converted to full service banking licenses wherever possible. And so it does not affect any of our employees because it's a new product for HDFC Bank, which they are not doing. It is complementary and there is no duplication in our activities today. As a result, the bank will require each and every employee of HDFC who are doing in the operations department, who are churning out loans. Like we said, we had a massive loan inflow of about 86,000 individual applications in the month of March. So you know what I want to end by saying that after 45 years in housing finance, after providing 9 million homes to Indians, we have to find a home for ourselves. And we have found a home in our own family company, HDFC Bank. One disclaimer I would like to urge the TV channels that I'm in no fit condition today to do a one-on-one interview because we had 2 sleepless nights. But I'll be happy to do it separately because there are 7 TV channels who have requested. I don't have the stamina today to talk to 7 channels. So please excuse me for a one-on-one. Thank you. I'll request Mr. Atanu Chakrabarti to say a few words. Then we can open up to question and answers.
Good afternoon, everyone. Mr. Parekh has very aptly and in a very concise fashion brought together the complexities of otherwise a deal of this millennium for the country's economic history in very short and pithy fashion. Today is a historic day. It's 2 institutions which are coming together, which are steeped in tradition of product and market leadership, deep customer understanding, delivering consistent return over the years, and impeccable corporate governance track record. And in a sense, it has been a growing up of a child which was a prodigy, which has matured and now also taking the parent along. So it's in a sense, as poignant for the bank as it is for HDFC Limited. And I'm really grateful to the entire leadership over all these years of both the organizations which have brought up these organizations to this path that they are turned out to be a real big engines of growth for the country. Companies do tend to come together, however, after 2 years of, the pandemic that the economies have been buffeted with, people had their personal tragedies. The timing that this transaction couldn't have come at a better time. Indian economy is now poised to grow. You all know the numbers. I need not reiterate it over next many years. And banking industry is well positioned with to make it grow. And these 2 organizations, when they come together, the big balance sheet that they bring in will also bring in a huge credit growth needed for the economic development of the country. And that's where actually the rationale of the entire deal derives itself. It is further predicated on the reforms that have taken over last few years, which inter alia include the GST, RERA, provision of especially RERA and GST and infrastructure status to affordable housing, which really make them sort of extremely creditworthy, budgetary incentives for affordable housing and many other policy incentives. And over the last few years, you were also seen and observed increased housing demand in Tier 2 and Tier 3 cities. And as the housing sector is very strongly coming into being again after a few years of being in a sort of plateaued growth, one is looking at a multi-year growth path. The mortgage contribution, I'll just give you a number, of the country to the nominal GDP is at about 11%. China stands at 20 plus and developing economies are close to 40. Now you see the gap and you see these balance sheets. I need not tell more about it as to how this gap is going to be fulfilled by these 2 balance sheets and bring the growth not only for the economy as well as for the combined entity that will come into being. As Mr. Parekh had alluded to, the NBFC's regulatory trajectory had been coming closer to the banks. That makes this deal that much easier in terms of the overall risk requirements that the regulator puts in for the financial institutions. To that extent, the requirement of CRR, SLR, and other various requirements which have been converging over the past few years and now come fairly close to each other. Of course, there are differentials which need to be phased in. Over the last 6 years, the bank has grown its book well with lower cost of funds, and some of the costs associated with merger like maintenance of statutory reserves on the merged entity has also come down. This along with the fact that affordable housing also qualifies for the PSL, makes the merger value extremely accretive and attractive for both the organization. The key subsidiaries of HDFC Limited, which are likely to be the subsidiaries of the combined entity, have built-in resilience and to also take external capital support wherever possible. To that extent, they are very strong in themselves and their balance sheets are equally powerful. And they are, in turn, also add a lot of value to the combined entity. The bank can now leverage its entire branch network. It will also be able to offer the entire bouquet of services to the HDFC Limited customers, which are considerable in number, and also complete, wherever required, the gap for 6.8 crores customers of HDFC Bank, especially with respect to the housing loan products. So that put together shows the large market that gets created on account of these two entities coming together. And of course, the possibility of leveraging the long tenor home loans to cross-sell other banking product and also make the books of the bank very stable. And a stable book for any financial institution, I need not reiterate, is always something one looks forward to. The coming together of distribution and customer leadership of HDFC Bank and the product and market leadership of HDFC Limited in the housing loan product, which is absolutely first rate, is, let me reiterate the things which earlier on Mr. Parekh had mentioned, as extremely value creative. And the skills are complementary in nature, and their coming together only enhances the value that could be delivered to the customers. Needless to say, the post-merger, the combined entity would continue to meet all the regulatory, incremental regulatory requirement on the regular basis that it has been doing till now. For the economy, its benefits, as have been outlined before, are naturally a large credit flow. Also, looking at the affordable housing, which is a big need for the population which is seeking shelter and wants it at a certain cost, that itself gets met, and also further provides impetus to housing for all initiative of the government by leveraging the low-cost fund of which bank has a very strong base. In turn, the bank would be able to offer the full banking services on the liability side, the deposit, etc., to the customers of HDFC Limited itself. There are three things which normally one would be looking at in such a merger of this size, which are essentially the culture, the systems, and the people. Culture, one on the business side, as I've just mentioned, and in detail, Mr. Parekh had explained to all of you regarding the business leadership. The other side is the assurance function, which is very critical for everybody to have that confidence that the combined entity would be able to stand and withstand any economic setbacks that occur in any cyclical economy. And those assurance function basically allude to the compliances, the risk culture, and the auditing mechanism which has to be risk-driven. Both these organizations are extremely compliant, as they are known as conservative, which is very important. To that extent, both the organizations tend to be a bit boring, but that's how it ought to be. It protects, keeps your money safe. And the second element of the systems is technology. And luckily, both the institutions have embarked on a very large technology revamp. And both the technologies and the system of both the organizations would be easily able to talk to each other and bringing them together would not be very difficult. In a sense, if you look at the back, there are no round circles, there are square and square. So there is no square peg or no round peg in a square hole. They're just two squares, so they will come together well. The other part is the people. Again, because of the complementary nature of the skill set that is needed, almost everybody from HDFC Limited would be required to be into the combined entity, as well as the growth opportunities of executives of both sides. And for the customer, as I need to reiterate once again, that a very strong, vibrant culture, a system which has technology which is taking the lead, whether it's a use of cloud or it's using of APIs to be talking to various other stakeholders. It brings to customer a great ease of being able to do business with a combined entity. And lastly, the people. To close, it is just the beginning of perhaps another journey for the combined entity, which will come into being after all the relevant regulatory approvals are obtained, and considering the fact that both the organizations have been complying with the requirements of the regulatory stipulations all the while, that would come through in its due course. The combined entity would sort of embark on a trajectory, on a growth path, which should not only mimic the growth of the country, but also provide a certain amount of impetus to the growth itself. Thank you.
Now we are open to question answers.
But he definitely dodged it. From here onwards, for the next 2 years, what is the role that you see for yourself, Mr. Mistry and Mr. Jagdishan, in the combined entity once the merger is over? And Mr. Jagdishan, whenever the merger of HDFC and HDFC Bank has spoken in the past, and we have spoken about this at your office as well, it said that this will be more value accretive for HDFC rather than HDFC Bank. If you can, enumerate, Mr. Parekh did speak about this at length, but if you can, as the MD and CEO of HDFC Bank, enumerate what this holds for you, or this is just done in a timely fashion to give HDFC a good home. Thank you.
No, you first. So you asked what will we be doing. First of all, this process will take anywhere between 12 to 18 months because of the numerous approvals we need. Reserve Bank of India rule does not allow anyone above 75 to be on a board of a bank. I have already crossed that age, so there's no way I can be on the board of the bank. So far as Keki Mistry is concerned, he's 67 years old. It will take a year or so. So he may have a year and a half possible to be a director on the board. He will not be a full-time executive, but he doesn't want to be a full-time executive. Not that we don't want him, but he can be a director on the board, and he can handle the mortgage functions, investor relations, whatever Shashi wants to do with Keki. We leave it to them to see. But we'll all be taken care of. You don't think that we'll be thrown out. It's a merger of equals, and it's a friendly merger. It's not at all hostile. And we are one. As Mr. Chakravarti said, as the son grows older, he acquires the father's business. So that's all happening here, nothing more.
You're right. Say probably 6 years ago when we did examine this, I acknowledge that at that point in time, both for the institution and for the bank, we did not see the value on a combined basis. It was because of the fact that the regulatory threshold levels was much higher. As he alluded to, the requirements were about 27%. You were still a young bank. We did not have the amount of deposit mobilization that was happening was just enough to take care of our needs. 3 years, the priority sector requirement, the only thing that we did at that point in time was just get into the foray into the deeper parts of the country. We still had not sort of really unleashed our product offering which was catering to the segment in the semi-urban rural parts of the country at that point in time. 6 years later, as we speak now, a lot of things have changed. Part of it, I think I'll be repeating some of the things that he mentioned, some of the things Keki mentioned in the call this morning, and Mr. Chakrabarti also mentioned, but I'll just try to put it in a capsule. Number one, the interest regime itself has come down dramatically. We used to be around the 7 to 8% 6-7 years ago. Now it's around the 3 to 4% levels. The moment you have a low interest regime, the drag on the reserve requirements, especially on the SLR and the CRR, is no more a drag. Your government security yields in the shorter end may be about 5% and odd, but in the medium to long term, the long tenor, it's around the 6%. A cost of funds are about 3 to 4%. It's still a positive drag, even if you take into account the fact that CRR is now going to earn money, but it's not a negative drag, it's a positive drag. So that's number one. On the other aspect of it is on the priority sector. The priority sector, yes, they have a large balance sheet now. 40% of that is going to be large. And there are sub-elements, which is what we need to meet as small and marginal farmers or the weaker section, because if you don't meet that shortfall, we need to keep it in the Rural Infrastructure Development Fund, where there will be a drag. Now, that's a reality. But there are a lot of things which have changed over the last 6 years. Number one, in the last 6 years, the bank has learned to unleash its product offering, especially in the micro enterprises sector, over the last 6 years, and more so in the last 2-3 years. If you look at the recent numbers which was published last year, the fastest growing engine for the bank is in the microservices segment, and that qualifies for priority sector. 2, if you look at the arrangement that we have with HDFC Limited, we have the ability to distribute HDFC Limited home loan, and we have an option to buy back. However, whilst we have grown on a CAGR of about 25% over the last 5 years on mortgage, we still are a small proportion of where the market is. Our proportion of mortgage in our book is just 11%, as against when you compare with some of the larger private sector and the largest bank in the country, where the proportion is much between 30 and 40%. So, and when you look at it, we have not actually unleashed this product for various reasons into all parts of the bank. We have only few branches which offer these products. When the regulatory approvals do come in, we have an opportunity for us to unleash it in all our distribution points. And our distribution points are not just branches. We are now today 6,300 branches. We have a capacity to add more and more branches at the same pace that we've added this year. We've added about 730 branches in a COVID year. We could sort of really ramp it up even in the future. And with this kind of an announcement, we probably may even step it up even further, because that all sort of helps us to not only mobilize deposits, but also sort of increase the distribution of loans, especially affordable homes. 50% of our branches are in semi-urban and rural parts of the country. The their product, which is in the affordable housing, is not something that we have actually penetrated much. The moment you start to launch that, and the moment you start to unveil that and unleash that, it's nothing that I did, but it's the institution is amazing. It's a 25 years of institutionalized processes. The sales execution engine is so good that come what may, you can't stop that growth engine at all. So we will fulfill our priority sector requirements on a self-fulfilling basis by moving the affordable housing through the rural and distribution network. In addition to that, we have the BC channel, which we have been talking about it from in our earnings call. We have more than 15,000 BCs, but we have expanded our partnerships to 5 other partners, so the reach will be even more. That will be powering more distribution of such priority sector products. The last but not the least is, unlike 6 years ago, we were, if at all there was a shortfall, we had to meet our priority sector either organically, or we buy priority sector from outside, or we had to invest in the rural infrastructure bonds. That needed funding requirement and more reserve requirement also. But now, over the last 6 years, there's been a very throbbing market on the PSLCs, or the certificates, the priority sector lending certificates. It's now reached almost 5.5 lakh crores, and it's only going to grow. So that's an easy way, maybe expensive because the cost ranges from 0.75% to 2.5%. It will sort of have a bit of an impact on the operating cost, but I think our revenues are reasonably strong enough to absorb that. But you don't need a funding requirement. So a large portion of that, 50% of our requirements can come out of that. And there's an appetite in the market for that. So eventually, this time around, the need to have the, us sweat a lot to get the deposits and reinvest in PSL is not going to be so much. It's going to be an effort. We will have a bit of a drag in the initial years, but I believe with the kind of expansion that we are doing in branches, the kind of foray that we are going to through our micro and small enterprises, the fact that we have never tested the affordable housing now, which we are going to be unleashing from all our branches, I think the drag should be much lesser. In fact, it will be accretive because the organic PSL will have a return on assets risk adjusted upwards of 2.5% to 3%, which is not a drag anymore.
Anurag, this side from Z Business. Deepak sir. Here sir. सर आपसे यही समझना चाहता था कि जो ऐलान किया मर्जर किया तो इसके पीछे जो आपने बताया कि क्रॉस सेलिंग है सबसे बड़ा वही मकसद है क्योंकि अब जिस तरह से आरबीआई के नए नियम आए हैं हार्मोनाइजेशन के तो उससे और जो कंसोलिडेशन आता था तो आपने पहले ही लीड ले ली और सर रेगुलेटर है कई सारे रेगुलेटर इसमें शामिल होंगे तो कितना कॉन्फिडेंट है कि आपको सारी मंजूरियां मिल जाएगी क्योंकि एक ही अगर हम बात करें तो आपकी जो HDFC बैंक जो होगा उसमें उसकी हिस्सेदारी 48% तक होगी HDFC लाइफ में तो आरबीआई के नियम जो है अभी हाल के दिनों में आरबीआई ने मंजूरी नहीं दी है इतनी ज़्यादा हिस्सेदारी तक आरबीआई कहता है कि बैंक जो है इंश्योरेंस कंपनी में 20-30% तक की हिस्सेदारी रखे
I'll answer your question in English if I may. As we said, we have large number of many regulatory approvals we need. We need the approval of insurance regulator, the pension regulator, SEBI, RBI, CCI, Competition Commission of India, shareholders. So all these are, the merger is subject to getting all these approvals. And that's the reason we said it'll take about NCLT, it'll take about 15 months, 18 months to get all the regulators. And there is a sequence on which how you can go. What is 1, 2, 3, how do we go? And so we are quite hopeful that, that we will get approvals from the regulators. We are positive we'll get a approval because it's positive for the economy. You need large banks in India. RBI is encouraging NBFCs to become banks. And for the NBFC also, as I mentioned, the arbitrage which was available in the past is getting narrowed and narrowed. So there's very limited advantage of being an NBFC because similar regulations of banking are coming to the NBFC sector, particularly the large NBFC sector.
A follow-up to that, Mr. Parekh, actually, would HDFC look to increase
its stake in the insurance companies to take it above 50% for the regulator's comfort? And has there been any preliminary discussion with the regulator on whether or not you will have to create this holding company structure once the merger goes through? And there's a second question after that, sure.
No, so you're right that RBI rule says either you have above 50% or 30%, and we are, I think, at 48 or something on our life insurance. So we have taken up the matter with RBI, and we've written that item with to the RBI, and we hope to get a reply sometime sooner. Permitting us to keep the stake as it is, or they may tell us to buy that 1%, which we can easily buy in the market to make it compliant to the banking regulation of 50%. But ultimately, what we have to do is many banks have life insurance and asset management companies. We have to comply with RBI regulations on this. If there's a change, we will accept the change. If the change is there for other banks, we'll have to accept the same percentage holdings. So that we have confirmed to the Reserve Bank that whatever they do for other banks who own insurance companies, the same will apply to us.
On the capital requirement, sorry, if I may, the additional...
Capital requirement, the additional CRR, the additional SLR, I think that is the biggest question for the investors as well. How much will that number be? Could you give us a figure, please?
See, what we have in our letter to the Reserve Bank of India, we have said two things. One is, please give us time to be compliant on our existing assets of HDFC Limited, a specific period of 2 to 3 years. But all new loans will be complied with the SLR CRR regulations. And so this is also one of the requests made to our RBI to give us time for the PSL, because we don't have MSME loans. We don't have agriculture loans in our books. Yes, we have a large amount of affordable housing loans, but not of these two, because there's a grading how much you can have, how much you must have for agri, MSME and affordable in that 40% PSL sector. So, and we always, under the LCR, we carry some amount of liquidity ourselves for our public deposits, which we take from the public, retail deposits. We anyway have to provide SLR. We have to have government securities. So we have to work out and see. We've not yet done a number of how much will it be, what will be the shortfall, what will RBI permit us to do, how long we will get to be totally compliant, grandfathering of our assets and liabilities. So all this is an open question. It depends how RBI responds to our letter.
And
Mr.
HDB
Parekh,
Financial,
if I
HDB Financial will
Continue to be an NBFC held by HDFC Bank. Is there any thought on that?
Till the effective date, we will be an NBFC in the housing finance sector. After the effective date, the NBFC will disappear, the HFC will disappear, it will all be one.
No, this was the HDB Financial. The
HDB Financial, again, we will do what RBI tells us to do. At the moment, it is almost 100% owned by the bank.
Yes, today it is about 95%. We would love to have it as a subsidiary, but if the regulatory prescriptions suggest that we may have to have an alternate thought process, we are happy to do so.
So has the regulators been already, there has been any discussion with regulators already, or you will move the application now? And one more question, sir. You mentioned about the RBI releasing the guidelines for NBFC. Was that a trigger point for taking this decision now?
So as far as the trigger point, as you said, is concerned, it's something which we have evaluated over the years. In the past, it did not make sense for a variety of reasons. One is at that time, the CRR SLR requirement was a lot higher than what it is now. Secondly, interest rates today are significantly lower than what they used to be. So if we have to raise money to put in for buying securities or for anything else, today the cost of that money will be a lot lesser. And also the regulations have changed. We carry a certain amount of LCR requirements, so we carry liquidity. So today the financial cost of a merger is virtually very, very limited. To my mind, once the merger is done, after the effective date, which should be EPS accretive from day one, from the very first year. And the reason is that 21% of our shareholding in HDFC Bank gets cancelled. So when that gets cancelled, the shares come down, which automatically triggers an increase in the EPS.
Well, so you've been talking about the cross-selling opportunities. When do you believe they'll start accruing and showing into the numbers as well?
It should start accruing and showing in the numbers reasonably quickly. Once the effective date sets in. So the way it is envisaged today is that till the effective date, which is the next whatever 15 months, 12 months, 18 months, whatever it takes, till that time the two institutions will operate as the way they are right now on a same basis as now. Once that gets done, then the integration process can be taken up in full force.
So should
but
we
the
expect
cross-selling can start quickly enough.
Sorry.
Sir, this is
So
Joel
should we
Rebello from the
expect that
Economic
in the
Times.
interim, the
Sorry.
growth will be a bit slower
Can you
because
give us a
the
chance?
focus will be more on execution of merger going forward?
No, I don't think there's going to be any challenge in terms of execution of a merger. That's not going to take time. To my mind, the ability to cross-sell products, whether it's mortgage products to HDFC Bank customers, whether it is products of life insurance, general insurance, asset management, to this whole pool of customers of the bank, that will increase significantly.
Sir, this
So
is
cross-sell
Joel.
opportunities will be higher.
Sir, this is Joel Rebello from the Economic Times. I'm sorry, I have to button. Can you see me, sir? Sorry. Sir, you all spoke about the SLR and CRR impact. Is there any calculation you all have done? You all spoke about the fact that it is lower now, the rates, SLR has come down over the years, and that's one reason why this merger makes sense. Is there any calculation you all have done on what will be the impact? Is there a number you all can share or anything you all can tell us about that? Second question is on the interest rates. You all said that rates are at the lowest or probably at the bottom, but they're only going to go up. And if this merger is going to take 18 months, you all are probably going to be at higher rate when it gets effective. So won't that, negate the advantages that you all have? Thank you.
See, to my mind, interest rates, even though they may go a little higher, are not going to be as high as they used to be in pre-COVID times. So in the past, when we had evaluated the merger, the interest rates in that period of time were significantly higher than what it would be, even if you assume that there are 1 or 2 rate hikes in the coming period. See, SLR, CRR depends upon, we've sought some kind of, we've spoken to RBI, we've told them that give us a little time to catch up with the CRR, SLR, PSL requirement. So a lot depends on what kind of response we get from RBI.
Mr. Jagadishan, this is Bijoy from Informist Chair.
RBI has responded to us that we have a letter from RBI and they say that your proposal under consideration. So we have to wait till RBI decides on the SLR CRR. We don't have any.
So if you really look at the balance sheet of HDFC Limited, I think they have a roughly about, it depends on time to time. I mean, the last reported number was about 4.4 lakh crores keki of liabilities, including borrowings, and embedded in that particular borrowing, they had some infrastructure bonds of about 80,000 crores, which is now, maybe at that point in time, it was 70,000 crores. Net of that, because that doesn't require to qualify for any of the reserve requirements, the approximate at 22% math comes to about anywhere between around 90 to 100,000 crores. Okay. Now, when you look at the excess that we have beyond, not just beyond regulatory requirements, but even with our comfort level from an asset liability match, we need to keep some cushion from both institutions. The number probably is already there. if you take 80,000 crores and you take the excesses that we have and the excesses that the institution has, and we probably would be building this from now to the effective date, that is not something that we are too worried about at this juncture. That's the reason why.
See, we would rather use the money that we have, what Shashi is talking, lending to the economy, lending for mortgages and lending for the bank purposes. And it's more accretive to the society, to the economy, because we have to increase the credit growth. If you want a higher GDP growth rate in India, you have to disperse more money. And if you invest in SLR, CRR is not going to do that to that extent.
Hi, sir. Hi, sir. Bijoy from Informist here. First of all, congratulations for keeping this under the wraps, because trust me, none of us were able to catch on to it this time. So good job on this one. You always complain that we break it before, but good one this time. Separately, sir, Keki sir, how important is it that RBI okays the grandfathering? That has been a contingent issue that has come up every single time. How important is it that RBI allow for these leeways for the merger to go through? And Shashi sir, so that I can close out my questions. Shashi sir, will there be a ramp up in the level of origination that HDFC Bank does during this transition period of 18 to 24 months or 12 to 18 months, as you may look at it? Thank you.
So to my mind, the RBI should give us the approval for the bank to hold the investments in HDFC Life, HDFC Asset Management, and the other subsidiaries. The way the similar exemption is given to the other banks which own insurance companies. So we are hopeful and we believe we should be able to get that approval. We would like to increase our stake in HDFC Life if possible, subject of course to regulatory approval. So between HDFC, HDFC Bank, we can take our stake up from the current level of 47.5 or 48 or wherever it is to 50% so that it remains a subsidiary of the bank.
So, hi, this is Subhashri from Bloomberg News. Shashi, I have a question. Oh, sorry.
Yeah, let me just respond to the second one. Yes, that will be the endeavor, because it's not just from a, not for anything, from a vested interest that there is a need, because when you start listening to the people of the ground, housing loans and home loans is something that all our customers are wanting. I probably may have said it in the past, but our penetration into the home loan portfolio is extremely small in the bank out of our 68 million customers. And if you look at our customer base, there is a large portion of our customers who have actually taken home loans from other banks. When you look at that, the size is equivalent to another HDFC bank. So it gives us a lot of, impetus for us to really focus on penetrating home loans into our customer base. And hopefully, Mrs. Karnad will be very kind enough to remove any artificial restrictions that she had all this while. And I'm sure she will allow us to ramp up the home loans during this period from today to the effective date. But that's the idea and that's the thought process.
See, on the other side also, I'd like to say that as of now, only 30% of HDFC's customers have bank account with our bank. So we have to now persuade them to use our bank and use the other services offered by the bank. So it's a two-way street.
Sir.
Son, on account of, somebody mentioned the capital, though are more of liquidity requirements. Please understand two things. There are questions in two broad buckets, which I feel there have been repetitions, are the regulatory liquidity requirements and the investments. Now on investments, there are very clear things that we see as banks like SBI, ICICI, Kotak, Axis, so on and so forth, do follow certain regulatory prescriptions of holding equities and controlling equities in certain insurance or AMCs and so on and so forth. And more or less those kind of regulatory prescriptions would follow in with some changes here with respect to grandfathering, for which regulator would take decision in due course to ensure that larger number of insurance, if you see there are a lot of insurance reforms that have taken place. Similarly, the same goes for savings to be pushed into equity linked or debt linked instruments. So that's where regulator will take a appropriate call, for which already prescriptions today largely exist with margin and deviation. Secondly, the problem on liquidity requirements come for those who don't have capital. These two organizations, please understand, are endowed with substantial capital. They believe in keeping a lot of capital, and they keep substantial liquidity reserves on top of it to ensure that rainy day requirements, cyclical requirements are fully met. And as the organizations grow, as I had mentioned, that in any case, incremental requirement would be met, and having, one NBFC has a particular regulatory regime in it works, bank is another one. So there is a phasing in requirement. For that, regulator will take a call, and these things keep getting smaller as days go. So it's only a guide map towards that is how to be handled. And I think RBI and other regulators would be in the best positions to decide on the guide map. As Mr. Parekh had mentioned, already they have been intimated of those requirements. Considering the liquidity requirement, it either goes, the large capital that the bank has either grows into the credit, that is credit growth, or goes into the SLR, where again a rising interest rate doesn't really hit the profitability. So I'm not getting into those kind of things. That's a regulatory call to decide on the growth trajectory of economy as a whole. So I think don't worry too much about these things. They will be taken care of.
Shashi, I have a question related to the motivation, the biggest...
Hi, Vishwanath from Bloomberg Quint. I just want to ask you, Shashi, considering that the last 18 odd months at the bank have gone in a significant tech upgrade, and a lot of management bandwidth has gone away in that, would the next 18 months and then the time after that to complete this integration fully, do you think that for the foreseeable future, this whole process of the management focusing on internal issues, is that going to be the future for HDFC Bank, at least for the next 3 years or so?
No, I think over the last 15 months, I think the leadership team, not just at the top, but even many levels below, have really, come together and have executed very well, whether it's on the heightened compliance requirements, on the new age technology architecture, in terms of trying to fight the COVID impact. 3 is trying to ensure that we maintain the asset quality despite the fact that a lot of our customers did get impacted. And 4 is continue to grow despite the tumultuous impact that we had on account of COVID. I think we are largely done. It's now a part and parcel of our day-to-day life. Now, as I think the seniors out here had mentioned, this particular execution or the need for intensity is not going to be as much as probably any other bank-to-bank merger. This is going to be a seamless dovetailing of the company into the larger umbrella of the bank. It's just going to complement our existing product offering. As he mentioned, we are going to be, we need people. Human capital is an extremely important one. We are going to be welcoming each one of them into our fold. In fact, we need more if we are going to really ramp up our distribution across all our branches. So, in my view, apart from a few hungry battery of legal experts and some of people who can, burn the midnight oil, they are the ones who are going to be ensuring that the legality requirements for the integration is going to be done. Of course, apart from that, we will have a plan for HR integration, for the system integration, which I believe should not be too much of a tough ask, because it's going to be a single monoline product company system. As someone was mentioning, it's just a lift and move and integrate into the core systems of the bank. So I don't think that's going to be really have a drain on our bandwidth. we probably have an opportunity for us to focus on ensuring that we step up our distribution of home loan products, as I just mentioned to the earlier question, over the next, from now to, or whenever the regulatory requirements, I know our legal person is listening to this very intently, so whenever he approves from that time to the effective date, we will be ramping up our distribution, and it's not going to choke our bandwidth at all.
So,
Mr. Jagdishan,
just seeking a small clarification, sir. You're ruling out the possibility of having to create a NOFHC? It will not, the holding company requirement will not arise at all. It's only the bank taking control. Absolutely, sir.
Proposal, the scheme which has been put out does not mention any FONHC, which is what you are referring to, that is non-functional holding, financial holding company, for which there have been discussions, but that's in the realm of discussions in the regulatory and general informed circles. This is these two companies coming together, the merger, and subsequently straightening out the holding which are down below. That is what it is in plain vanilla terms.
Okay.
Mr.
Sir,
Jagdishan,
in the earlier transactions, we've not had the RBI give dispensation or even grandfathering. I'm referring to the IDFC transaction here as far as CRR, SLR is concerned. So what is the plan that HDFC Group has in case the RBI is going to stick to its ground?
We'll cross the bridge when we come to it. So we are capital adequate organizations, so that's not an issue. So Parikh had also referred, the capital either goes towards SLR bonds or goes into the credit flow. So as I said, that's not really an issue which is on the table. Let the regulator take a call and not try to sort of prejudge them today. Whatever the call they take, the companies have adequate capital to handle it.
Mr.
I mean, just to put that in perspective, the actual capital adequacy of the bank will go higher after this transaction.
Mr. Shashidhar, I have a question from Bloomberg, Subhashri here. Just two reasons of the motivation. Is the key reason the size for you, the size and scale, the number one? And number two, sir, I heard Mr. Mistry say that the merger will also open up about 7% of FII investment in the bank. So is that another, because you are the most valued bank in the country, in terms of the market cap, you are creating a behemoth, both of them together. So is that also a motivation for the merger? Thank you.
The primary motivation is fulfilling the latent demand of housing into our customer base. As I mentioned and I repeated, our penetrations are very low. We practically are losing our customers to other banks. Now, not just the home loans, but it's a very sticky product. If the customer is taking a loan from outside, what happens is even the liability, because he has to now pay the EMIs from our account to the other bank. It has a double whammy on that. So the primary motivation is that we have an opportunity, not just from our taking the mortgage penetration high, but also it will also help in ensuring that the outflows that happen on account of the liability franchise will also be protected. But more than that, they also have 10 million customers. Maybe a certain portion of them will be very active. The penetration there of our products is very low. So it has another opportunity for us to penetrate, and we have a lot of the complete suite of ex-mortgage consumer products as well for us to cross-sell there. So that's the primary motive. What you said about the FI holding is just a secondary, it's a collateral benefit.
It's a collateral benefit which we didn't think of it till our investment bankers told us that there is an additional benefit, that it opens up some gap in FII holding.
Icing on the cake, sir.
Mr. Jagdishan, Manojit here from Business Standard. Can you throw some light on the board composition of HDFC Bank post the merger? Apart from Mr. Mistry, any other officials will join the board of the bank? Because you have not received RBI approval in recent times to induct fresh board members.
No, I will let the seniors talk about this. The board of the bank.
Already that question has been answered. See, the board of the bank today has a very robust corporate governance structure. It would follow the RBI guidelines regarding the requirement of fulfillment that directors must fill with respect to, the kind of expertise and domain knowledge that they need to have. Within the HDFC board, they are extremely capable directors for whom there is adequate requirement and space in the board of HDFC Bank. However, those issues will have to be addressed also in discussion with the regulator, and also to see how each of the directors is meeting the requirement, both with respect to their domain expertise, which exists, as I mentioned, also with respect to age and their previous residency on the bank board itself. So those are many requirements that they get.
It's a premature question because we've not taken a view yet. It's still 15, 18 months away, but we'll take a view nearer the time.
Mr. Jagannathan, one more thing.
It's
HDFC
business
Bank.
as usual now.
Okay, sir. Thank you. Thank you. One more question, sir. HDFC Bank take huge pride in the fact that they maintain net interest margin at between 4.1 and 4.4% for the last 10, 15, 20 years. Post this merger, do you think the margins will squeeze considerably?
See, you have to look at the margin in conjunction with the operating costs and the risk cost or the credit cost. The margin for a book where you have a certain proportion of non-retail assets, that is wholesale assets and retail assets, the margin has always been between 4 and 4.4%. Because we had a kind of, in the DuPont analysis, the operating costs and the credit costs was in a certain range which could give us a return on assets between 1.8 to 2%. Now when you look at it, obviously the margin or the spread on a mortgage book is going to be lower. So the simple arithmetic of that will depress the margin. But along with it, because it is a larger ticket than any of the consumer product that the bank has, and the duration is longer, the operating costs on that particular ticket is going to be lower. Plus, you look at the track record of the credit costs on housing portfolio, it's much, much smaller than any of the unsecured loans that we have. So when you look at the margins, even though it will be depressed, net of the credit costs, it will still be much better on an apple-to-apple basis. So what you need to look is the return on assets, the risk-adjusted return on assets. That will be, if at all, stable, or it could even expand.
Since you have ADRs, is there any requirement for approval from US authorities?
No. We have examined the battery of legal experts who probably may be here as well. I think have examined this particular subject. I don't think there is any requirement of any regulatory approvals from SEC. And if you go back in time, I think the bank, which files its 20F on an annual basis, have already put this in the risk factors, saying that they could, if there is a potential merger, these are the implications. So from an investor perspective and from a regulatory perspective, in the United States, I think the disclosures are adequate.
Hi sir, this is Amol here from
Last question.
Hi sir, this is Amol here from ETBFSI. My question is specifically about the cross-selling, which you mentioned that the cross-selling will be an added factor for the combined entity. Could you please tell us how much is your cross-selling business right now, and by what percentage it will grow because you have a large number of employees, large number of branches going ahead?
I don't think we can answer that question because we don't have the numbers. As I mentioned, 30% or only 30% of our customers we know have a bank account with HDFC Bank. 70% of home loan borrowers have bank accounts with other banks. So we have to lure them to come to HDFC Bank. Similarly, there are HDFC Bank customers who've gone for their housing loans to other banks. We have to try and synchronize our operations and try and capture the market as the years go on. So it's difficult to give a percentage of cross-selling, but HDFC Bank is a distributor, is a large distributor of life products, is a distributor of mutual fund products, and gives us loans, housing loans also. About 25% of our loans come from the sourcing of the bank. So as a distributor, the bank with its numerous branches is a good source. Now, how much cross-selling, exact numbers and all, we don't know.
Sir,
I have a question for...
Sir, this is Sandeep Singh from the Indian Express. Sir, you have a very sizable and profitable developer finance business. HDFC has a developer finance business. Now, that won't be available as a bank. So, how will that be treated in the existing books, and how do you see, will that impact the business going forward in the profitability sense?
There's nothing which prohibits a bank from doing construction finance. In fact, one of the ways of increasing the retail business, the individual housing finance business, is to give construction finance loans where the product, the housing loan product, can be targeted or can be explained to the people who are buying those apartments. So I'm sure it is a product a bank would be interested in.
Sir, I have a question for Mr. Shashi. This is Gopika from Mint, right at the back. So I mean, it said that this gives space, the deal gives space to underwrite large ticket loans, including infrastructure loans. So what is your plan with regards to infra lending? How big do you want to go? How much of the book are you looking at? Considering you have been a late entrant into the space, so what kind of opportunity or how aggressive do you want to get into?
No, number one is we have, it's not that we're not doing infrastructure lending. I think today when you really look at it over the last 10 years, I think the bank has, between our coverage team, which is the corporate banking team, and the investment banking team, they have sort of learned how to assess term projects, infrastructure projects in a manner that today we are one of the largest, or maybe the second largest distributor of syndicated loans and debt products. So this particular enhanced capital will only allow us to sort of give larger ticket loans. So we have the expertise, we have a wonderful coverage from the corporate side and investment banking side in terms of doing these kind of products. We have never said no to this. We have done even, and if you look at the kind of duration of our corporate assets, there are now term finance assets as well. But the rating of these assets are something that we're extremely proud of. We pick and choose some of these things which, where we are extremely comfortable from a credit perspective. And now if the infrastructure opportunity is going to be enhanced, I think we will for sure, have an opportunity to do even larger ticket because we have a better appetite now.
You know, we've started at 6:30 in the morning, so we're all hungry. We have our board of directors and advisors. So I think we've answered most of the questions you've said. So I think let's break for lunch and please join us for lunch.